A pullback in silver can look like nothing more than a tired chart catching its breath, but sometimes the quietest drop is the moment a market stops asking for attention and starts preparing an ambush. The headlines cool off, the weak hands leave, and underneath the surface, the system that priced silver too cheaply begins to crack. If you like staying close to the signals that hide behind the noise, keep this channel near you, because this is one of those stories that looks small right before it gets very big. Picture a saver glancing at silver after a sharp run, seeing the price slip and thinking the chance is gone. That reaction feels sensible. It feels safe. It also happens to be how people miss some of the most violent upside moves in markets. The title says Ray Dalio warns, and that matters because Dalio rarely talks like a man chasing a shiny object. He talks about systems. He talks about debt, currency, power, and the long cycle that turns confidence into excess and excess into strain. In that world, silver is not just a metal, it becomes a pressure gauge. Dalio usually points people toward the big forces first. Too much debt, too much money creation, too much dependence on promises that only work as long as trust stays high. And when trust starts thinning out, even a little, hard assets begin to look less like speculation and more like memory. That is why this story matters to normal people, not just traders staring at screens. When money loses strength, life gets heavier. Rent hurts more. Groceries feel rude. Retirement math stops making sense. A pullback in silver is not just a chart event if the bigger machine is still under stress. It can be the market taking a breath while the reasons for higher prices keep building. That is the part many people miss. They think price is the story, when price is often just the mood. Silver has a strange personality. Gold is treated like a king. Copper is treated like a worker. Silver lives between them. It is part money, part machine, part fear, part future. That split identity is exactly why silver can shock investors. When economies slow, people worry about growth. When debt grows, they worry about money itself. Silver can catch fire from both directions. It can rise because industry wants it and because savers stop trusting paper. If you come here for calm thinking when the crowd starts reacting instead of reasoning, stay with this channel, because silver only makes sense when you zoom out far enough to see the system around it. Now think about the pullback itself. Why do these drops happen in assets that later go much higher? Because markets are emotional machines. They flush out late buyers. They punish people who bought excitement instead of understanding. Silver is especially brutal that way. It is smaller than gold. That means less money is needed to move it hard in either direction. A smaller market can swing faster. That is why silver often feels wrong right before it feels obvious. And this is where Dalio's framework becomes useful. He has spent years warning that debt does not stay harmless forever. When a country piles up too many obligations, meaning promises to pay later, the system gets boxed in. Raise rates too much, and the debt load hurts growth. Cut rates too much, and the currency can weaken. That trade-off matters more than most people realize. Governments do not like recessions. They do not like debt crises. They do not like unemployment. So when pressure rises, policy often leans toward easier money, lower real returns, and quiet currency erosion. Real return is a simple idea. It is what you actually earn after inflation. If a bond pays 4%, but your cost of living rises 5%, you are not getting richer. You are losing purchasing power in polite language. That is the ground silver stands on. If the world is drifting toward more debt, more fiscal stress, and more pressure to keep money loose, hard assets stop looking optional. Gold usually gets attention first. Silver often wakes up later, then moves with much more aggression. A family in that environment does not need to know every central bank term to feel the change. They just notice that their paycheck stretches less. Their savings account looks active but feels weak. Their retirement plan grows on paper, yet the future still feels more expensive than the statement suggests. Think about a retired couple. They spent 30 years doing what they were told. Save steadily, avoid drama, trust the system. Now one partner looks at food bills, insurance, property taxes, and medicine and wonders why being disciplined no longer feels like enough. This is where silver becomes personal, not because everyone needs to own it, not because it solves every problem, but because it represents a simple question. What happens when the things that are supposed to be stable stop holding their value the way people assumed they would? And the numbers under this story are not small. The silver market has been running deficits, meaning demand has been higher than supply. In 2024, the deficit was about 148.9 million ounces. Industrial demand hit a record near 680.5 million ounces, and solar alone used roughly 197.6 million ounces. That matters because silver is not rising on one narrow trend. It is being pulled by several hands at once. Solar panels need it. Electronics need it. Electric vehicles use it. And when fear enters the room, investors want it too. Even with signs of slower demand in some areas, the imbalance has not vanished. Industry estimates for 2025 still pointed to another market deficit around 95 million ounces. That would make several straight years of shortage. A shortage does not guarantee a straight line up, but it does mean the floor is not where many people think it is. And if you find value in following these quiet imbalances before they become loud headlines, make sure this channel stays in your orbit, because the most expensive stories are often the ones that still sound boring. There is another layer here. Silver supply does not respond like flipping on a switch. A lot of silver is produced as a byproduct of mining for other metals like lead, zinc, copper, and gold. That means miners do not always increase silver output just because silver gets exciting. So the market can tighten faster than casual observers expect. Recycling helps, but recycling has limits. Old jewelry and scrap can come back into the market, but not enough to erase a structural deficit if industrial demand stays firm. That is when a small market starts behaving like a squeezed spring. This is also why silver often lags gold, then suddenly overreacts. Gold moves first when trust weakens. Big money buys it. Central banks buy it. Institutions understand its history. Silver sits in the background, almost ignored, until people realize the move is broader than they thought. Then the gold to silver ratio starts getting attention. That ratio simply shows how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is very high, silver looks cheap relative to gold. It does not mean silver must rise tomorrow, but it tells you the gap has become hard to ignore. Now, a normal viewer might push back here and say, this all sounds dramatic. If silver is so powerful, why is it famous for disappointing people? Why does it pull back so hard? Why does it keep scaring its own believers? That is a fair doubt. Silver is volatile. It attracts emotion. It gets overhyped. And yes, if you buy it for the wrong reason at the wrong moment, with the wrong size, it can punish you faster than gold. But that doubt becomes incomplete when it turns into dismissal. Volatility is not the same as weakness. Sometimes volatility is just what happens when a small market is tied to very large forces. Silver does not drift like a sleepy asset. It snaps. Another objection sounds even stronger. What if industry starts replacing silver? What if solar companies use less of it? What if technology finds a cheaper substitute and the whole demand story fades? That concern is real, and parts of it are already happening. Manufacturers are trying to thrift silver, which means using less per solar cell. Some are exploring copper in places where silver used to dominate, but that does not automatically kill the bigger story. First, silver still has unique traits. It is the most conductive metal on Earth. That means it carries electricity extremely well. Replacing it is possible in some applications, but not painless and not always fast. Second, even if each unit uses less silver, the number of units can keep growing so much that total demand stays strong. That is the part people miss when they only read one headline. If a solar panel uses less silver, but the world installs far more panels, the overall appetite can remain huge. The same logic applies to electrification, data centers, advanced electronics, and power infrastructure. The future is trying to use less silver per unit while building far more units. Have you noticed how the biggest market moves often begin when the argument against them sounds perfectly reasonable? If that pattern matters to you, stay with this channel because this is where the quiet contradictions usually live. Now widen the frame again. Dalio's warning is not really about one metal. It is about a world leaning too hard on debt and too confidently on the assumption that money can always be managed without consequence. For a while, that belief works, then interest expense rises. Refinancing gets harder, politics gets louder, and policy choices get worse. When governments owe vast sums, every rate decision starts hurting someone important. Keep rates high, and the debt service bill swells. Debt service is just the cost of paying interest on what has already been borrowed. Lower rates too fast and you risk feeding inflation, weakening the currency, or reviving the very imbalances that caused trouble in the first place. That is the trap, and trapped systems often create strange price action. Stocks can look fine while households feel poor. Bond yields can look attractive while real returns stay weak. Currencies can look strong against weaker currencies and still lose purchasing power against hard assets. Silver lives inside that tension. Gold has been the cleaner response to this global unease. Central banks have been buying gold, not silver, because gold is the reserve asset with the long official history. But that can actually help silver later. Why? Because once investors accept the hard asset case through gold, some of them begin looking for the smaller metal with more torque. Torque is just leverage without borrowing. It means something can move more dramatically because the market is smaller and the starting point is more neglected. Silver often behaves like that. It is not the first choice in a fearful world. It is the asset people rediscover after the first choice has already moved. That is why pullbacks matter so much. They are the moments when the story gets tested. If the reasons for higher prices are fake, the asset fades. If the reasons are real but the move was too hot, the asset corrects, cleans out weak positions, and builds a base for the next leg. To the impatient eye, those two things can look identical. Now imagine three roads from here. The first road is disinflation with weak growth. That means inflation cools a bit, but the economy slows enough that central banks feel pressure to ease. In that world, silver could wobble at first because slower growth hurts industrial sentiment, then recover hard if easier money weakens real yields and brings investment demand back. The second road is stickier inflation. Prices do not cool enough. Debt keeps growing. Government spending stays heavy. Bond markets get uneasy. In that path, gold likely stays strong, and silver can follow with more speed as investors realize cash is not as safe as it looks. The third road is disorder, not necessarily collapse, but stress, a geopolitical shock, a funding scare, a policy mistake, a sudden loss of confidence in how stable things really are. That is the kind of environment where silver can first drop with everything else, then reverse so fast it leaves people staring at the chart in disbelief. If you prefer perspective over prediction and want a clearer map through these kinds of turns, keep this channel close because the market rarely sends engraved invitations before it changes character. Who gets hurt first if this trend continues? Usually not the loudest person online, usually not the professional trader who can hit a button in seconds. It is the quiet saver, the retiree, the family sitting in cash, thinking safety means standing still. They get hurt because inflation does not arrive like a siren. It arrives like friction, a little more here, a little more there. Then suddenly, a decade of caution buys less than expected. And the people who trusted the old formulas realize the formulas were built for a different era. That is why the silver story is bigger than silver. It is really a story about delayed recognition, about how long people can live inside a changing system before they admit the system has changed. Most wealth transfers happen like that. Not with one dramatic headline, but with a slow shift in what money can still buy. Silver also carries a psychological trap. Because it is cheaper per ounce than gold, people think it is simpler. It is not. Its lower price does not make it less serious. It makes it easier to underestimate. And because it has a history of violent swings, many people only meet silver at the most emotional moments. That is the worst time to meet any asset. The better time is during discomfort, during the pullback, during the part of the story where conviction is low, headlines are mixed, and the market is asking whether you understand the reason you are there. That is where real positioning begins. None of this means go all in. That kind of thinking belongs to manias, not to wisdom. Silver is not a magic shield. It is not a guaranteed trade. It is a volatile, hard asset tied to both monetary stress and industrial demand. That means it deserves respect, patience, and proportion. A sensible person might treat silver like a piece of preparedness rather than a lottery ticket, not the whole answer, part of an answer, a way to hold something outside the promise system while still acknowledging that the world is messy and outcomes will not arrive in a straight line. That mindset matters more than any price target. And if you want more conversations that help you think clearly before markets force you to feel urgently, make sure this channel keeps finding you, because preparation is usually quiet long before it becomes obvious. Go back to that retired couple for a moment. One of them hears silver mentioned and shrugs. Too volatile, too weird, too late. Then the months pass, rates shift, costs keep climbing, gold keeps acting firm, debt headlines get worse, and suddenly the thing that looked random starts looking connected. Or picture a younger worker in his 30s. He has done almost everything right. He works hard, he saves, he buys index funds. He trusts the long run, but he is beginning to sense that the long run may include more currency weakness, more policy intervention, and more instability than the textbooks promised. He does not need to panic. He does need to adapt. That is where silver can enter the conversation, not as an act of fear, as an act of realism, as a recognition that the world may be moving into a phase where scarcity, trust, and monetary strain matter more than many investors grew up believing. And when those forces meet in a market as small as silver, surprises tend to be violent. The pullback then is not the whole story. It may be the pause that reveals the story. A short stretch where excitement drains out, but the deeper drivers remain. Debt still sits there. Deficits still sit there. Currency pressure still sits there. Industrial demand, even with efficiency gains, still sits there. So when someone says silver could shock investors after this pullback, the important word is not silver. It is shock, because the shock rarely comes from nowhere. It comes from people realizing all at once that they were looking at the dip while ignoring the system underneath it. That is the lesson inside Dalio's warning. Watch the cycle, not just the candle. Watch the debt, not just the daily move. Watch trust, because markets can survive bad news longer than they can survive a slow change in belief. And when belief starts to move, prices often race to catch up. Maybe silver does not explode tomorrow. Maybe it chops sideways and irritates everyone for longer than seems fair. That happens. But if the debt cycle keeps tightening, if real returns stay under pressure, and if the world keeps demanding more from a metal that is already running structurally tight, then this pullback may one day look less like an ending and more like a loaded spring. The people who understand that will not look the smartest in the quiet moments. They rarely do. They may even look early. But early is often what patient looks like before the crowd gives it a better name. And when the next phase begins, the shock will not come from silver becoming something new. It will come from the world finally noticing what silver had been telling us all along.